Hello, I'm Peter Herbert from Insight Training. Welcome to today's short session, one of a series that we're running currently, looking at topical accounting, auditing and company law issues relevant in the current climate. Today's session is going to look at dividends. Let me begin, if I could, by sharing my screen. Okay, I think with the economy in free fall and balance sheet under real pressure, it's really important at the current time that organisations think very carefully about their dividend policy. What we're going to cover off in today's session is some of the legal and accounting issues around paying dividends, and then some practical tips to share with you and your clients. Let's begin, if we could, by looking at the agenda for today's short session. We'll begin with the legal essentials. We'll then move on to think about key considerations in the current climate and things that might reduce the ability of a company to pay a dividend. We'll think about different ways to pay with particular focus on directors' loan accounts, and finish off with a couple of legal cases and their implications. Let's begin then with the legal essentials. Okay, so we're talking here about rules on distributions. To all intents and purposes, distributions and dividends means the same thing as far as today's session is concerned. Distributions can only be made from profits available for the purpose. And of course, in determining whether you do have enough profits available for the purpose, you're looking at your accumulated realized profits less accumulated realized losses. So you're looking at it from a balance sheet point of view rather than from a profit and loss point of view, and saying, have we made enough profits in the year to justify a dividend being paid? Balance sheet point of view is what prevails. Now, for PLCs, the specific and additional net assets test. We're not going to cover that today. We're going to focus more on private companies. But the decision to make a dividend payment is also going to be based on looking at relevant accounts. Now, relevant accounts are the company's last annual accounts circulated to the shareholders. Where a distribution would contravene the Companies Act by reference to the last annual accounts, you can justify a payment by reference to interim accounts. So you can use interim or management accounts to justify a dividend payment being made, but those management accounts need to be properly prepared. So the question you've always got to ask yourself is, has appropriate provision been made for up-to-date stock valuation, depreciation, appropriate provisions, and also tax liabilities? Have those things been factored in? That would make those proper accounts, properly prepared accounts, and that will then indeed justify a distribution being paid in that situation. There are specific rules applying to distributions being made in a company's first accounting reference period. And again, those rules are more onerous for PLCs than they are for private companies. Okay, so here's the scenario. We've got a situation with a company here with a 31/12/19 year end. And the question we're posing is, 2020 dividends will not be a problem because for 31/12/19 year ends, COVID-19 is a non-adjusting post-balance sheet event. Is that right? Now, as we covered off on the previous two webinars in this series, from a purely accounting point of view, it's very likely the 31/12/19 year ends that COVID-19 will be a non-adjusting post-balance sheet event, but that does not mean it's of no consequence at all in relation to the decision to make a dividend payment in 2020. It's very relevant in 2020 in terms of informing a dividend payment decision, and that's all to do with the common law rules in relation to distributions that we'll now cover. So the common law position is that even if relevant accounts show sufficient profits, you have to consider if subsequent losses have eroded those profits in terms of making a decision on dividends, and that has got to be considered at the time of making that dividend or distribution payment. So you've got to think very pragmatically about the position at the point the dividend is going to be paid, even if that bad news scenario is not necessarily reflected as such in the 31/12/19 year end accounts, on the basis that at that particular point in time, from a pure accounting point of view, COVID-19 is deemed to be a non-adjusting post-balance sheet event. And the other point here in relation to the fiduciary duty is directors must also act in the company's best interest. So think about solvency and liquidity issues. So even where at the point of making a distribution payment, there are sufficient distributable profits, will that payment impinge adversely on solvency and liquidity? A further fiduciary duty and another therefore very important further consideration in informing that decision to make a dividend payment in 2020. Okay, so we said that distributable profits are accumulated realized profits less accumulated realized losses. Let's do a little bit of a deeper dive on those two elements now and think about what might impact them in the current climate. So, realized profits. Profits in the form of cash or other assets, the cash realization of which can be assessed with reasonable certainty. That's what we think about realized profits as being. And they talk about in that context the importance of qualifying consideration. Now, I guess in the context of that particular qualifying consideration aspect, where you've maybe got debtors on your balance sheet that you consider to be recoverable, the sales that you've made that contribute to those debtors are very much part of your realized profits, where we're assuming that those debts are capable of being settled in a reasonable period. If in the context of the current climate, you're taking a different view on the recoverability of your debtors, that's got to impinge adversely on your realized profits and therefore your ability as a company to make a dividend payment. The point about assets readily convertible into cash is an interesting one in the context of FRS 102 and the treatment of revaluation gains. We do, of course, under FRS 102 see revaluation gains on investment and invested property washing through the P&L. Now, from an investment property revaluation gain point of view, we do consider those gains to be non-distributable on the basis that the assets concerned are not readily convertible into cash. But that's not always going to be the case on things like equity shares, where those assets are actually quite readily convertible into cash, and therefore related revaluation gains would very much be considered to be distributable from a company law point of view. Maybe in the current climate, though, if it's harder to actually realize those assets, a gain that you may have thought a few months ago would be a distributable gain, based on the asset being readily convertible into cash, you might now take a different view. And that will again all impinge ultimately on the total amount of realized profits and therefore the amount available for distribution. Realized losses. So losses are generally considered to be realized unless a specific point of law or accounting standard, etc., provides otherwise. And yes, I guess on the right-hand side of this slide, loads of food for thought in the current climate. Impairments, revaluation losses, onerous contract provisions, and the like, all really, I suppose, depressing potentially the amount of distributable profits based on more realized losses than were there before. And again, to reiterate the point here, it may well be at 31/12/19, a lot of those issues are not be dealt with in the accounts, but where they're in the pipeline for 2020, they've got to be taken into account in terms of that common law obligation, which therefore really does mean from a dividend payment point of view, companies to be thinking very carefully in the current climate about the bad news down the line and what impact that's going to have on their ability to make dividend payments. One specific point I wanted to cover here, which we do get asked quite a lot about on courses, Company A bought an investment property for 300k in 2017, 350k carrying value in 2019 at the year end, and then a professional valuation recently performed for the bank reveals a current market value of 280. What we're asking therefore is that particular revaluation loss in any way a realized loss that might again impinge on the total quantum of distributable profits. Quite good guidance on this one I picked up from looking at the Institute of Chartered Accountants in England and Wales and the Institute of Chartered Accountants in Scotland's joint guidance on distributable profits in TECO 217. Really good detailed paper. And they made the point there that cumulative net losses on fair value accounting, which is of course what we're doing here, will be unrealized only if firstly profits on remeasurement of the same asset would themselves be unrealized. And that of course here is very much the case, isn't it? Because if we're looking at a situation whereby we're going to revalue investment property upwards, that upward revaluation gain would not be realized and therefore the downward revaluation loss would not be either. But the key thing to focus on, I think, here is the second part of that second sentence in red, and the losses would not have been recorded other than pursuant to fair value accounting. If we've been using historical cost accounting for investment property rather than fair value accounting, would a situation have arisen whereby the cost of 300,000 would have to be marked down to, say, 280,000? Well, yes, it would in the event of the asset being impaired. To ascertain the need for an impairment write-down, you would compare the carrying value, say 300, with the recoverable amount. And the recoverable amount, of course, is the greater of the net realizable value and the value in use. If you do that theoretical calculation and say off the back of that, we would need to write the asset down to, say, 280. That shortfall would be, even though we're actually applying fair value accounting here, a realized loss, and that would then impinge on our total amount of distributable profits on that same basis. So that's the way to think about it in that situation, where you've got invested property assets that are suffering diminutions in value at the current time. Okay, so that's looking at some of the key considerations in relation to the impact of the current climate on the actual quantum of distributable profits. Let's move on now, if we could, and think about different ways to pay. To kick this section off, what I wanted to briefly do, if I could, is give you a very interesting and useful case which really reinforces the idea that illegal dividends in companies are a real problem. Let me explain the case here, and it's one called It's a Wrap UK versus Google, dating back to 2006. Now, what happened in this particular case was you had a situation whereby the directors of the company were paying themselves dividend, not salary, because it was more tax efficient. The company made losses, and there were therefore not distributable profits available to justify that dividend payment. When attempts were made to claw the money back, what the proprietor said was they knew that there were no distributable profits. They knew that they were making dividend payments, but they were not aware of the specific Companies Act section which said you can't make a dividend payment in the event there are no distributable profits. And essentially, in the Court of Appeal, that argument was thrown out. They should have known better. So you may not know the detailed rules in the Companies Act, but as a director, you're expected to know that if you're making a dividend payment to yourself in the absence of there being distributable profits, there will be an implication in terms of that particular amount being capable of being clawed back. So I think that's the key thing. Make illegal payments at your peril. There can be implications down the line. And that's why I think here we're saying, think very carefully about that policy in the current climate. Now, other ways of extracting cash could involve maybe making payments to owner managers on PAYE. Now, that I appreciate from a tax point of view probably is less appealing, but that could be a route to go down, a safe route to go down. There is, of course, a plethora of government assistance schemes around as well that can help get cash into proprietors' hands if they really need it. But the one we think probably is very relevant in the current climate that we probably will anticipate companies using more is the director's loan account. And what I want to do in this section, if I could, is talk a little bit about some of the accounting implications of there being a director's loan account in use to get money to directors, and also one or two points as well that HMRC have raised in recent publications on this topic. So remember that when you've got an overdrawn director's loan account where the company lends to a director, that's what we tend to refer to as an advance. And advances, credits and guarantees are, from an accounting point of view, dealt with by Section 413 of the Companies Act, and they require disclosure in the notes of the accounts. Now, the disclosure requirements are on the left part of this slide here. The key thing to bear in mind in terms of the disclosure regime here, though, is you have got to incorporate a Section 413 disclosure note when the director's loan account goes overdrawn, whatever regime you apply. So FRS 105, FRS 102 Section 1A, full FRS 102, or IFRS. Now, we get tons of questions on this. I'm going to limit myself here to a couple of points which come up quite regularly, just to sort of reinforce and reiterate. There's no requirement for disclosure in relation to the director's loan account under Section 413 if throughout the accounting period the loan account's been in credit. We're looking at overdrawn positions here, not situations where the balance is in credit. Also, really importantly, it may well be that the loan account's in credit at the start of the year and at the end of the year, but if the loan account's gone overdrawn at any point in time during the year, you will need to include a Section 413 disclosure, as I say, whatever the accounting regime that you're actually applying. Now, some interesting tax observations here. Stumbled across this document, some of you may well be more familiar with than I am. It's a very useful director's loan account toolkit, and I put a link on the slide here to where you can access that from if you want to have a look. But they make a whole load of points about the practicalities of loan accounts and what they're interested in. What I'm going to do is flag 4 or 5 points here that I think are interesting and link in to what we're covering off on today's session. Okay, so have expense headings which include non-business expenditure paid to or on behalf of directors being reviewed to identify any non-business elements. Fairly basic point, that, isn't it, really? It's quite simply saying that you can't have personal expenditure from the directors washing through the account as a deductible P&L expense. If there aren't any of those amounts within the P&L, they've got to be moved from the P&L account and reclassified as debits to the director's loan account. Fairly obvious, but obviously quite important point. Have any relevant credits to the loan account been correctly calculated? Now, I think it's interesting here that they're emphasizing not only the importance of correct calculation of things like bonuses or credits that, or dividends rather, that might be credited to the loan account, but also the importance of making sure those credits, in fact, entries generally to the loan account have been processed on a timely basis. And I think the chronology of the accounting here is very, very important. The danger, I guess, could be if you get the accounting timing wrong, you could end up in a situation whereby a loan account that was genuinely overdrawn at some point during the year does not give the impression of being, and that from an accounting point of view, therefore, would mean that the section 413 disclosure note would be missing where it was required. So I think timing as well as quantum of credits and debits to the loan account are really, really key. And that's obviously a point here that HMRC are equally reinforcing. Have all transactions relevant to the loan account been posted contemporaneously? Has there been timely posting of transactions based on what's been approved and what's been paid? And again, I suppose one of the points that really resonated with to me here with this HMRC Toolkit document was that where the loan account goes overdrawn to the tune of more than 10,000, that can be construed as being a beneficial loan. That can have tax consequences. Very important, therefore, that transactions are posted timely or contemporaneously to make sure that if that situation has arisen, it's appropriately flagged and the appropriate steps can be taken to pay the relevant amount of tax. Many of you, I'm sure, will be across the relevance of Section 455 of the 2010 Corporation Act. So we've got an overdrawn loan account position which is not being repaid within 9 months of the year end. There's a tax liability there to pay for the company, which again, I'm sure many of you will be familiar with. And some very interesting stuff within the paper around the importance of thinking about loan accounts for individual directors separately rather than lumping them all together and considering them as one. So the consideration of joint loan accounts or accumulated loan accounts can be appropriate in a family context, but outside of that, each loan account separately, and the implications for accounting and tax will flow through from there as a result. So really interesting paper. Do have a look. There's more stuff in there besides, but those points I think really resonate with me, and they link in, I think, some of the key themes on today's short session. Okay, let's finish off then with one or two legal cases and their implications. The first one's called Mathuri Delivery versus HMRC. This, I think, really reinforces the importance of contemporaneous recording of transactions washing through the loan account. What was going on here from what I read was those unexplained movements between the company records and the director's private accounts that HMRC wanted to get a better feel for, understanding of, and they've therefore asked for a detailed chronological listing of all the transactions washing through the loan account to really understand the position. Now, the company basically pushed back on that and tried to appeal the requirement from HMRC for that particular detail, partly on the basis that what they didn't really think was appropriate for them to have to do was to pay their accountant, their external accountant, to provide that detailed analysis. But the appeal was dismissed, and the conclusion was that information about the nature, size and timing of payments between the company and the individual can be reasonably acquired by HMRC, and if that therefore requires the company and their accountant to provide a detailed chronological analysis of transactions washing through the loan account which wasn't otherwise available, then so be it. I think the key message is there. It reinforces the importance of good record keeping, timely voting on things like dividends and bonuses, and appropriate contemporaneous recording of those particular transactions to make sure that from an accounting and a tax point of view, we get to the right answer. Global corporate behaviour. This is one that again resonates a little bit with the earlier case you're looking at. It's all to do with situations where a company had got payments being made to directors, director shareholders being classified and described in the accounting records as dividends made. The company went into liquidation, and the liquidator had to claw back the payments from the directors on the basis that they were unlawful distributions. What the company argued was that what their protocol had been, like so many companies, was to make dividend payments in the moment during the course of the year. And if there's not enough profit available at the end of the year, justify those payments being made, what they then would do would be to reclassify them. And therefore, in the greater scheme of things, in the fullness of time, these payments weren't dividends and could not therefore be construed as being illegal. It went to the Court of Appeal and essentially the directors lost. And the outcome was a conclusion that if you make a dividend and call it a dividend at the time of payment, it remains a dividend, you can't change your mind later. Okay, so thinking about appropriate voting of transactions on a timely basis, recording of transactions, and then not trying to then rearrange things to purport to give a different impression to what was given originally. That's the key message, I think, again, there from the case of Global Corporate versus Herbert. Okay, so that wraps up today's short session. A few possible takeaways. So to reinforce the idea that the approach to dividend payments requires careful thought by companies in the current climate. We talked about the importance of the Companies Act requirements there, the sort of common law requirements there, and the fiduciary duties on directors to think about and take into consideration at the point of getting towards making dividend payments. We've seen from a couple of cases that where dividends are paid illegally, the courts can take action to claw those amounts back. It really does happen. We talked about the overdrawn loan accounts from the point of view of the accounting and section 4 and 3 disclosures, and from the point of view of HMRC. There's some interesting insights there as to how they perceive it and the link into tax obligations that can fall due. And we've talked in that regard about the importance of detailed contemporaneous record keeping in relation to all relevant payments, more than ever, I think, important in the current climate, but clearly something that is very much on HMRC's radar. Okay, in terms of follow-up, do drop us a note to inquiries@insight-train.biz if you've got any questions about the content on today's session, or if you want to copy the slides, or where you maybe got ideas for future sessions. We'd love to hear from you. Do check out www.insight-train.biz for information on our forthcoming sessions, including our longer interactive live seminars over the spring and summer of 2020. And do check out www.onlinetutors.co.uk, some excellent resource there from Dean Wootton on the tax implications of the current situation. All free resource. That's a very good place to look at there for additional stuff to help you at the current time. Okay, let me finish off if I could by just stopping my screen share and saying thank you so much for listening. Hope you found it useful and look forward to speaking to you all again very soon.